Hey guys, hey Ryan, hello Greg, how you
How
doing?
are we, boys?
I thought I'd just jump on an impromptu video chat. I think for the benefit of all readers, really, it's been a pretty tumultuous time the last few days. It all started last week with I don't know what happened first. Actually, I know Warren Buffett sold half of his Apple stock, which was quite a significant move, and I know that caught a bit of attention. But then the Japan raised its interest rates, which strengthened the yen, and it set off a whole chain of events ever since. And I know it's Ryan. It sparked a good discussion between our editors and all the team here over the weekend. So I thought it would be good to get you guys on camera because I know you both got some thoughts as to what's going on and what's happening, and maybe we can decipher and explain a few things for readers. So what is going on? I mean, the market's open today. That everything's down. Gold's taken a hit too. Bitcoin is down 10 or 11%, something like that. Japan's circuit breakers went, so it was down 6% on Friday. It's down a further 6% today, the Japanese market. And you just said to me just now, Ryan, before we hit record, that South Korean has also halted trading too. So it feels like there's some pretty big stuff going on. Maybe you want to set the scene for us? I know you've been writing about that for Factel
Yeah,
Daily today.
I wrote about it today and went into a bit of detail, but just to give you the timeline of events from last week. So, like you said, you had the Japanese central bank raising rates, like not much, but the Japanese central bank, it was only the second time they've raised rates in 17 years. So that's an unusual event. So that, like you said, caused a little bit of interest, caused the yen to start going up in value. And then I think it was the next day in the US, they had a surprise jump in unemployment. They got a 4.3% reading when the market expected closer to 4.1. And so you had suddenly the expectations of a rate cut in the US just went up massively. So suddenly you had this divergence where Japanese interest rates are going up and the expectations for US rates are coming down. Now that was not what was expected even a week ago. People thought that the Fed might, soften a little bit, and there might be some sort of soft timeline into easing. But now they're pricing in, 6 cuts in America in the next 4 meetings. That's the probability based on the market pricing. So that was a dramatic turnaround. And then on Friday we saw these big moves on the back of that. The Japanese market fell, tech stocks in America fell hard, and everyone was trying to wondering what was really happening. And I spent the weekend looking at it and trying to work out what's going on. And what found out was there's a huge amount of investors in this thing called a carry trade. I've seen various reports, but it's somewhere between a 4 trillion and $20 trillion market. It's a big market, right? And what it is these investors borrow money in Japan at low interest rates, and they invest it in other places to try and earn a higher rate of return. And a lot of them they can invest in anything, but they could say borrow in Japan at close to 0% and invest in US government bonds at close to 5% and just make money on the spread. It's really easy money. Or they could invest in tech stocks like the NASDAQ, which was up 16% this year, or they can invest in crypto or any other thing they want. But it was an easy source of borrowing for them at really low rates, which they could invest elsewhere. Now, suddenly that trade has become less profitable for a number of reasons. One, because interest rates in Japan are going up. Two, because the yen is going up in value against US dollars. So if you've borrowed in yen, it's suddenly more expensive to pay that back. And then at the same time, you had this big tech market sell off in America. So the value of your investments were going down. So what started to happen was that these carry trade investors started to panic a little bit. Because remember, none of this was expected a week ago. Those macroeconomic things were shocks. So they start to sell more stocks so they could pay off these loans in Japan. And because it's such a pretty big market of hot money, it's just magnified and fed upon itself. So all these hedge funds are now racing to sell assets over, say, in the US and pay back these loans in Japan. And that's reinforcing this cycle of panic and selling. And it's why you're seeing stuff like the Japanese yen go up. So that's what's happening. And that started happening on Friday, and then over the weekend, a bunch of people must have realized they were looking at getting trapped in the same boat. So then when markets opened this morning, within minutes, the Japanese market fell a further 6%. As you said, that triggered the circuit breaker. Japan's largest bank fell 12%. I think it's down 20% over 2 days. So what I think people are worried about now is like, how long is this carry trade unwind going to go for? Because until that selling process works itself out, you're going to struggle to get a bounce. And the other thing, which is maybe a further worry, is there a contagion effect? If these hedge funds have borrowed money and they're trying to pay it back, what happens if they can't pay it back? Who's on the hook for that money? So it's one of those panic moments in market. I think it's worse than Black Monday in 1987 in Japan. Like so far, it's been a worse result than Black Monday, which is a famous moment in 1987.
Yeah.
But look, at this point, we don't know how ongoing or serious it will be longer term. We don't know if this is a real economic shock or just a case of hot money trapped in a trade that suddenly is less profitable and they're trying to get out. And it could be that once all this money works itself out and gets itself out, things will stabilize. So we don't know that, but that's probably what we're trying to work out right now.
What just this might be a dumb question, so just let me know if it is. But I get that Japan raising rates is a big event because it's been the first time, or what do you say, second time in a long time that they've done it. But it's only a marginal amount, really. So, what is it? The fact that there could be unknown leverage involved, which starts contagion effect.
It's not really the fact that they did it by a small amount, which is what they did. It's the fact that they did it and they hardly ever do it because they've been stuck close to zero for years, decades. But it was the fact that they did it, and then in the same week, it's suddenly the market said, it looks like the US economy might be in a recession, and they're going to decrease rates dramatically. So it's that divergence which got the market spooked. Suddenly, it looks like US rates might come down, 2% by March next year. At the same time, Japan, who've got a bit of inflation to deal with, and our colleague Nick Hubble, who lives in Japan, says from the Japanese consumer point of view, inflation is a much bigger deal to them than the market. So the Japanese government might keep rates higher there in Japan to deal with inflation. So it's that divergence you've got between the various rates of the Japanese central bank and the US market and the effect that has on that carry trade profitability. So that's what is the big deal. It's not the fact that it was a small raise from the Bank of Japan. It's the fact that they did it, even though they hardly ever do it, which means they must be semi-serious about the inflation problem there. But it was the fact they did it, and then the very next day, America got a shock unemployment figure, which suggests they might be in a recession, which suggests the central bank might have to reverse course pretty quickly, cut rates pretty quickly, and you're seeing the Japanese yen go up strongly. Because remember, for a carry trade, if the Japanese yen goes up versus the currency that you're invested in, you start losing money because you need to pay that back. It's like going overseas on holidays and suddenly the currency, the place you're going to, your currency's gone down. It's more expensive. You know what I mean? So it's the same thing for them. But when you're talking north of $4 trillion worth of investments in these carry trades, they are sort of like all in the same boat. And in these types of situations, a lot of the time, margin calls kick in, which can accentuate selling, or they're just a rush for people to either lock in profits or try and lock in losses before they get out of hand. So I think that's sort of why it's a big deal. What are the fact Japan did it? Yeah.
What are your thoughts, Greg? I know. So in today's meeting, we had a bit of a meeting with all the team, and it became a kind of a mini editorial chat, really. But you likened it to the tech correction, as opposed to a long-term capital management thing from 1998, which caused a global contagion.
Yeah, I guess with the caveat that, as Ryan said, we just really don't know how this is going to turn out, whether this is just a short-term unwinding of some leverage trades. From a broader systemic perspective, I don't see a huge amount of on a scale of where, say, it was back in 2007, where you had huge amounts of leverage into property and all the derivatives on the back of that. So we're not in that type of situation. What I find interesting is that literally on Thursday, the Aussie market hit an all-time high, and there was general bullish optimism about the rotation trade, money coming out of large tech stocks going into all the smaller cap stocks, and pretty much 24 hours later, the tune has completely changed. So just to give it some perspective, we are the market's down about 3% today. The ASX 200. We are around 5% from all-time highs. If you look at the indices, they're still in uptrends. So there's there's not a huge reason to panic right now, even though I think, there is clearly some panic going on. And I think a lot of that relates to what Dinse was just talking about, to do with this sort of big money. Japan's clearly at the epicenter of that. Related to your point just a moment ago, whether this is similar to the early 2000s tech unwind or not, again, that remains to be seen, but there are some similarities. So you've got the Magnificent Seven, which capital concentrated in for the most part of this year. Any type of momentum trade went into those large cap stocks. And around the same time as what Dinse was talking about with the situation in Japan, the question mark started to come up whether these large cap tech stocks can maintain their rate of profit growth that they have been, because they're pumping or investing billions of dollars into the global data center rollout, and the returns on capital from that investment are starting to be questioned by the market. So up until literally just a few weeks ago, it was all growth from these companies, awesome business models, and very positive sort of views. But now, with the quarterly results that have come out that have revealed how much they're investing in this data center rollout, questions naturally are starting to come up. Okay, what's the return on capital going to be? Can these guys sustain their return? So while this has happened, everything else has happened, money's coming out, and now you've got a situation where you've got some stocks that are very, very, in my view, overvalued, and other stocks that are quite reasonably valued. I don't think there's a situation where the whole market is at risk. I think there's certain segments of the market that are highly at risk. And just for a local example, you look at Commonwealth Bank, which I wrote about a couple of weeks ago in The Insider. It was trading on 23 times earnings for a mature bank in a local economy that is almost not growing. That is very, very stretched valuation. Then you look at companies like BHP and Rio that are trading on 9 times, 10 times earnings, because there's concern about China, there's concern about iron ore prices. So there's a big difference between big companies, and some companies are very, very attractively valued in this market, and there's some companies that are very, very excessively valued. So I think, and this is one of the themes that I go on about quite a lot with the members in my service, is that you have to understand there's a difference between price and value. And if you focus on price only, you're going to get freaked out when these things happen, because you're going to look at the price moving around and you're going to panic. Whereas if you have a good understanding of what the value is of the company you're buying, you can look at price moving around and not be too concerned by it. And I think from my perspective, I just see this as exactly what Dinse was saying. There's clearly some big money factors going on, very, very short term. Even though we are only 5% from all-time highs, it does feel like there's a bit of an inflection point in terms of the sentiment that's happening in the market. Sentiment has turned very quickly from bullish to almost panic. So this could indicate there's a bit of a turning point in terms of just the direction of the market over the next, let's say, 3 to 6 months. From my perspective, as someone who looks for and constantly on the lookout for good value opportunities, I think this is a good development. I don't think the market's on the cusp of any type of major crash. We could see a 10 to 15% correction if we do go into a recessionary environment. To be fair, we probably are close to a recessionary environment already. The Aussie economy, I think, grew at 0.1% for the June quarter, or sorry, for the March quarter. The June quarter is probably going to come out in the next 4 to 6 weeks. We'll get a sense of where we are in that. Reporting season starts next week, or kicks off this week actually, but it really kicks into gear in the next couple of weeks. So you get CEOs starting to provide commentary on what the current operating environment's like. I think that's going to dictate the direction of markets. But I think it's good to try to keep some perspective as well. There are clearly areas of the market that are doing quite well, and there's some that are struggling. You look at Wesfarmers, JB Hi-Fi; they were making all-time highs just last week, and they're clearly consumer discretionary stocks. So we can't be too get in too much of a panic over a couple of days move. You have to sort of keep this into perspective, see how things unfold over the next couple of weeks, and make some judgment calls from there.
Yeah, so I guess that's what you're telling your readers this week, Greg. And I know the similarity. I know you guys focus on
Yeah.
different types of companies and stocks and everything. But one thing you both do have in common is that you focus on value over price, and that's true with Bitcoin, right, Ryan. Now, I'm
Yeah.
assuming on the Bitcoin and the crypto side is you're probably telling your readers to maybe top up if you can, take advantage of
Yeah.
these fools. I don't. Is
Look,
that correct, or are you going to be telling them?
unfortunately for me, unlike Greg, the places I invest in or advise in, like technology stocks and crypto and Bitcoin, they'll get hit
I was
pretty
going to
hard
come
by
to the
this.
tech stocks in a bit. Yeah.
Yeah, well, like there's always a degree of speculation in those areas, and you can't necessarily wait for obvious value, except in times of huge market crashes, but they're very rare. So a lot of the time, you have to have some gauge of sentiment and some gauge of momentum to try and find attractive um, entry points for investing, and that's hard to do. But it means sometimes you have to pay up for a good stock in a good sector, as opposed to wait for an obvious discount. And so that's why when I was looking at this stuff over the weekend, I was a little bit worried. I was worried, but I was thinking, well, what should we do with our tech stock portfolio? What should we do with Bitcoin? Is it the play to get out, hit the sidelines, and wait for an entry point on a broader panic, or just ride it out? And at the moment, as Greg said, I don't think it's a systemic risk. So it is the case where I think right now it's just a matter of riding out the volatility. We talk about Bitcoin or crypto. I've lived through many, many moments like this in Bitcoin and crypto. I've seen the price, 18 months ago, the price of Bitcoin was 15K. And one well-known macroeconomist said we were going to hit a price of minus 1,000. I'm not sure how Peter Zihan worked that one out, but people were calling the end. And then 18 months later, we're 60,000, above 60,000. So sentiment in Bitcoin, especially, can change very fast. And what sentiment on Bitcoin what Bitcoin tends to react to more than anything else is global liquidity. And part of what we were talking about before with potential interest rates coming down in the US, and you're seeing other liquidity events from central banks, they should ultimately support Bitcoin and crypto, because Bitcoin is a scarce asset. There's only a limited supply of it. And the more fiat money that's injected into the system, Bitcoin usually reacts very positively to that. So I don't know how long it will take, and I don't know how long this panic will stay in the markets. And as long as it does, Bitcoin and crypto are looking pretty shaky. But at some point, I think when we get the inevitable central bank reactions and the rate cuts and the liquidity injections, the rebound for Bitcoin will be very strong. And look, it's very hard to time those things. So usually, like you said, I say to subscribers, just write it out. It's a volatile asset, but it's still up almost 100% a year. So it's just one of
Hey,
those
Dinse,
things you have to
just
write out if you have
just
got. Yep.
sorry, mate. I was going to ask. You mentioned
Yeah.
central banks and their response there. I guess this is a big question mark at the moment. Is that central banks have been fighting inflation for the past 2 or 3 years. To what extent are they going to be quick to move, and are investors thinking of the pre-COVID environment where anytime there was a market hiccup, central banks would come to the rescue? Do you think it's going to be more a situation where they will be prepared to see more pain before they react? There was a commentary in the Fin Review today where an economist was calling for an RBA rate hike rather than any easing. So there's this sentiment around, or there's this feeling around, that central banks shouldn't be so quick to cut just to help out markets and liquidity, given that it could flow through into the economy and create more of an inflationary problem.
Yeah. That is something to think about. But I've heard a lot of that stuff from economists, generally speaking. And I heard that at the start of last week, people were calling for interest rate hikes in the next RBA meeting. But I think things have changed dramatically. If you look at the pricing for interest rate cuts in America this week, it has changed dramatically. The market's going to put severe pressure on the central bank anyway, and it's going to do that through selling and selling down markets and repricing bonds and all that other things that they do. They're going to put pressure on central banks to react. And look, it's an election year in America. There's an election coming up. How much financial pain? I'm not saying like there's political interference, but it will have some bearing on how central banks in America will react to that pain. On the inflation front, I don't necessarily look. I look at some data from a company called Trueflation, which measures a bunch of price points all over the world. and they've had inflation coming down pretty dramatically over the last 2 months. Now they've got a reading of 1.5% in the US, which is obviously the official reading's like about 3%. So the central bank's always going to go off its official data, but the trueflation data, even if it's just directionally correct, suggests that prices have come down a fair bit in the last 2 months even. And a lot of the time, economists are looking at backwards looking data. And in my experience, economists get a lot of forward looking calls wrong because they're always looking in the rearview mirror. So you're right in the sense that, yeah, is this pre-COVID? Is it Jerome Powell riding to the rescue? Probably not, but I still think they will ease to some extent a few times before the end of the year if the financial markets are looking too shaky. And like we said at the start, we don't know if there's a contagion effect that could be in play. There might not be, but with Japanese banks falling pretty dramatically, there's some people obviously worried that there could be some contagion into the financial system on some level. And once it starts hitting one sector, it can flow globally because it's just the nature of interconnected markets. So I still think interest rates will be part of what we see in the next few months. And in China, they've got other tools of liquidity, but in China they've started adding liquidity to their market as well. So that's another factor behind global growth. And obviously they've got their own problems with property, but they've started trying to support the economy with various liquidity injections and interest rate tools. So I, you know, I personally think they will ride to the rescue in some manner. To what extent they do it, I suppose, is the question. But I don't think they're going to sit back and do nothing if we get a few more, days or weeks of the current market action.
You mentioned China there, Ryan. I've got one final question to end on, and it's for you, Greg. You mentioned in a discussion earlier today that you noticed that China's in recovery mode, and it's been largely unaffected by what has transpired over the last few days. And I think you even mentioned in your portfolio you've got a couple of China-related ETFs which have actually ticked up a bit. So I don't know if there's any thoughts you want to end on there, like what's happening. Or
Well, I think
what does that
it just
tell
tells
you,
us that China's
basically?
not necessarily been linked to the global cycle that, say, Japan and the US are involved in right now. China's been trying to manage the deflation of its property bubble for the past couple of years. It's actually been lowering interest rates for some time. It's been experiencing deflation or lower inflation than the rest of the world, so that they didn't suffer any of the effects of the, the COVID inflationary spending that the Western world did. They have a relatively sensible energy policy where their energy security is front of mind, so they haven't had energy-driven price inflation either.
Yeah.
But in saying that, their stock markets have been down considerably, so they are recovering from very low levels. So if you look at the relative performance of the Chinese stock market relative to the S&P 500, the S&P 500 massively outperformed over the past few years. But from a relative value perspective, China's starting to look, quite attractive. So I recommended a couple of those ETFs a few months ago. And when you look at the performance of stocks or sectors on a day like today, you can see where the relative value is, because those the panic selling of China was done back in January. If you look back at the lows of the Chinese stock market, there was a panic sell off and a panic low in January. And on a day like today, there's clearly no hot money in there to sell off anymore. So when you see those indices popping up a little bit, and also, as Dinse pointed out on one of our internal threads, the renminbi, the Chinese currency, was up today, so that's obviously benefiting things as well. So that comes back down to just my personal philosophy. I try to look for markets where they've already been washed out, they've already been terrible sentiment, and you think prices can't get much worse. And often they're the best opportunities to get into from a longer term perspective. So it remains to be seen whether China is definitely recovering, but certainly from today's action, you're seeing those China ETFs pop up a little bit relative to the rest of the world, which is severely under pressure. It just tells me there's a bit of relative value there. And look, that bodes well, I think, for the Aussie commodity sector as well. The commodity sector in around the world has been under the pump. It's all been about quality growth stocks, tech, capital light businesses, and most, apart from gold, I would probably say most commodity sectors have been really struggling recently. You've seen lithium completely beaten up, rare earths, a lot of those critical metals have really sort of struggled over the past for 2024 and haven't really enjoyed the rebound that the rest of the market has. But I wouldn't be surprised if this is a bit of a turning point for commodities. I think there's a lot of relative value there. There's a lot of attractive opportunities. So I wouldn't be, I'm keeping a close eye on that sector to see where the capital flows. Certainly from an energy perspective, I do a lot of work on looking at energy long-term long-term sort of forecasts of energy. One of the really interesting things that popped out for some work I did over the weekend, if you look at the amount of gas-fired power plants that are under construction or in development at the moment, it represents 40% of installed gas power capacity around the world right now. So we are going to increase by 40% over the next few years the amount of gas-fired power stations that are and part of that has to do with the huge demand that's coming from data center rollout. So there's a lot of underlying forces that are in play at the moment that I think lead to or point to attractive investment opportunities, certainly in the commodity space. So that's where I'll be looking, and I think that's where we might get some opportunities out of this in the next few weeks.
Awesome. All right, guys, I think we'll leave it there. Thanks for jumping on. We will be sure to keep updating everybody as the story plays out. It's a fascinating time to be looking at the markets and be invested in them. The key thing is to look for value in whatever you're doing. Know why you're invested in something, and just acknowledge the price, but don't let it overtake.
Right, thanks, guys. Bye.
Yeah.
Guys, thank you.
Yeah.